Most people think Christmas is about gifts, lights, and celebration. But behind the scenes, while the world is distracted, governments, banks, and billion-dollar institutions play their biggest move of the year. And this year, something unbelievable happened. The rules of the silver market were quietly changed. Right when liquidity is low, trading desks are understaffed, and retail investors are emotionally distracted. It wasn't a coincidence. It was a trap, a Christmas trap. One designed to stop silver from doing something historic, something the elites can't afford to let happen. Reaching $100 per ounce. For decades, silver has been the most manipulated asset on Earth. Not Bitcoin, not gold. Silver. The metal that runs the world's real economy: solar panels, electric cars, military tech, medical instruments, AI hardware, satellites, and the green energy revolution. Demand for silver has exploded to levels the market was never built to handle. The problem: there isn't enough silver left above ground to meet the demand. Mines are producing less. Inventories are shrinking, and industrial consumption is devouring supply faster than nature can replenish it. If silver hits $100, the global financial power structure cracks. Because silver isn't just a commodity, it's the backbone of industrial infrastructure and monetary trust. And a surge to $100 exposes a truth they've spent generations hiding. The system has been selling silver that doesn't exist. Paper silver, futures silver, synthetic silver, ETF silver, digital claims on silver bars that were never there. This year, hedge funds, commodity whales, and Eastern sovereign buyers started draining physical silver from vaults. London, New York, Zurich, New York, Zurich, Singapore. Retail didn't notice. The news didn't cover it. But insiders were panicking, because the moment vault inventories run out, price suppression becomes mathematically impossible. And then, in the final 10 days of December, when trading volume, historically, collapses by nearly 40%, the rule change hit. Margin requirements were raised, delivery conditions were altered, short-selling exemptions were expanded for select market makers, and certain settlement windows were mysteriously extended beyond January, all executed under the cover of holiday-thin trading. The effect was instant. Retail traders suddenly needed more collateral to hold silver positions. Many were forced to close, not because they wanted to, because the new rules demanded it. But here's the twist. The institutions that were already short silver, they were quietly protected from the same margin pressure. A two-tier market. One rulebook for you, another for them. And it worked exactly as intended. The rally slowed. Momentum fractured. Social media arguments replaced coordinated buying. Fear replaced confidence. And uncertainty replaced outrage. This was psychological warfare, disguised as regulatory housekeeping. But why silver? Why now? Because 2025 was shaping up to be the year the silver lie died. Global inflation is no longer a forecast, it's a lived reality. Currencies are collapsing against real assets. Central banks had bought more gold in the last 3 years than in the last 30. But silver was the one asset retail could still afford, and that made it dangerous. If millions of retail investors realized silver was the cheapest door into the biggest monetary reset in modern history, suppression wouldn't stand a chance. So the trap wasn't just financial, it was informational. Because a market you don't understand is a market you can't defend. And now we arrive at the real suspense. The elites succeeded in slowing the price temporarily, but they failed to stop the catalyst. The physical drain didn't pause for Christmas. Solar manufacturers didn't stop consuming silver because of a margin hike. Military procurement didn't delay deliveries because of settlement rule changes. And the vaults didn't magically refill themselves because regulators signed a memo. The world is running out of silver, and no rule change can rewrite geology. Now let's talk about the bigger picture most people will miss. When rules change during a rally, it usually means one thing. Someone big is about to lose control. Because you don't rewrite regulations in stable markets, you rewrite them when the existing structure is about to break. This means silver isn't weak. It means silver is close. Close to breaking suppression. Close to exposing the naked shorts. Close to revealing the rehypothecation chains. Close to detonating price discovery. And most importantly, close to forcing a market repricing event so violent that even Christmas distractions can't contain it. Let's rewind history to understand the mechanics of suppression. In 1979, silver spiked from $6 to $49 in 12 months. The Hunt brothers weren't stopped by supply, they were stopped by rule changes. Exchanges raised margins, limited buying, forced liquidation, Sime playbook. Different decade. About this time the market is global, digital, decentralized, and fueled by industrial demand, not speculation alone. In 2011, silver climbed from $18 to $48. Then, margin hikes again. Position limits again. Liquidity freezing again. The price collapsed 34% in 8 days. Retail called it volatility. Insiders called it intervention. But 2025 is different, because this time, silver demand isn't being driven by billionaires trying to corner the market. It's being driven by industries trying to survive the future. The Hunt brothers squeezed the price. The world today is squeezing the supply, and squeezing supply is unstoppable, because price can be engineered, but supply can only be mined, and mining takes 7 to 10 years to scale. You can't manufacture silver overnight. You can't 3D print it. You can't synthesize it. You can't replace it in solar efficiency without losing output. You can't swap it in microelectronics without overheating circuits. You can't remove it from missile guidance without losing conductivity precision. Silver is not optional. It is mandatory. That is why suppression exists. Not to stop traders. To stop truth. Now let's decode the psychology of the Christmas trap. Timing matters more than mechanics. Late December is when retail investors historically pool capital for holiday expenses, when traders mentally detach from markets, when institutions push narrative control because journalists are on vacation, when price anomalies can be blamed on seasonal volume instead of structural stress. It's the perfect cover for intervention. Raise margins when retail is emotionally unavailable. Let volatility look natural. Let regulatory bulletins drop unnoticed. Let forced liquidation look like personal choice. Let confusion do the rest. And here's the uncomfortable truth. The trap works best when the public never realizes it was a trap. But you're watching this video, which means you're already outside the fence of distraction. Now comes the most important twist of the story. The rule changes were not a signal of the end of the rally. They were a signal of the end of the strategy that was suppressing it. Because the institutions didn't raise margins to stop silver forever. They raised margins because they know the price can't be contained much longer without blowing up their own balance sheets. This was not a move of strength. It was a move of desperation. The kind you make when your only defense is delay, not victory. Now let's talk about the data that the public doesn't see, but the vault custodians do. Registered silver inventories on major exchanges have been declining for years, but in 2025, the slope turned exponential. LBMA vault balances have been drawn down by sovereign buyers who are taking delivery, not rolling contracts. COMEX registered silver, the metal actually available for delivery, not the eligible category that can be leased out, has been shrinking relative to open interest at a ratio that signals fractional coverage stress. ETFs continue to report holdings, but holdings are not the same as unencumbered bars. Many of those bars are already pledged in collateral chains, leased, swapped, or financed in liquidity operations, which means the world isn't running out of reported silver, it's running out of available silver. There is a difference. And that difference is the fuse. Now let's talk about the villain of this story. Paper silver. Over 90% of silver trading volume is derivatives, futures, options, and unallocated claims. The price you see is not the price of physical metal, it's the price of contracts referencing it. And for decades, institutions have used infinite contract supply to absorb by pressure while routing physical delivery requests into settlement delays or cash compensation. But when physical supply shrinks enough, the contract market becomes exposed as fiction, and fiction cannot settle delivery. This is why rule changes hit when they did, because delivery pressure was rising, not price pressure. Price was just the symptom. Delivery was the disease, and the cure they attempted was delay. A regulatory pressure valve, but now we reach the suspense loop. What happens when the public comes back from Christmas spending? What happens when January trading volume returns? What happens when industries continue consuming silver at record pace? What happens when investors realize the rule change wasn't to stabilize the market but to stabilize the shorts? You get the squeeze of the century. The one they've feared for decades. The one they delayed in 1980. The one they delayed in 2011. The one they tried to delay again now. But this time the world isn't waiting for a billionaire to corner silver. It's waiting for the vaults to empty. And empty vaults are the end game of suppression, because manipulation requires supply to lend, and you can't lend what you don't have. Now let's talk about who is really accumulating silver. India imported record silver volumes this year, not for investment, but for solar and fabrication. China continues dominating solar manufacturing, which consumes massive silver throughput. The U.S. defense budget allocates silver for classified electronics and missile conductivity requirements. Mexico, one of the world's largest silver producers, is consuming more domestically for industrial processing. Instead of exporting raw output, Russia has been increasing strategic metal reserves, including silver for industrial and monetary hedging. The Middle East, quietly diversifying from oil dependence, is moving into metals linked to electrification infrastructure. None of this pauses for Christmas. That is why the trap only slowed the chart, not the catalyst. Now let's talk about the future they're trying to hide. By 2030, solar capacity alone will require hundreds of millions of ounces of silver annually. Electrification grids require silver for relay conductivity. AI data centers require silver for advanced cooling and circuit efficiency. Space programs require silver for radiation-resistant electronics. EV batteries don't use silver directly, but the charging infrastructure and power regulation around them do. Every future industry is a silver industry indirectly. The problem: there is no spare supply for the future. We are consuming tomorrow's silver today. Now we reach the cliffhanger. The elites think in decades, but nature doesn't negotiate in derivatives. The market can absorb infinite paper silver, but it cannot absorb infinite solar demand. The market can expand settlement windows, but it cannot expand mine output. The market can force retail liquidation, but it cannot force industrial substitution without systemic failure. And most importantly, the market makers can change the rules, but they cannot change reality. And here is the final suspense twist that guarantees retention, if executed visually and narratively in your video. When suppression breaks, price doesn't rise gradually. It gaps. It reprices overnight. Because when a market realizes supply is fictional, the price jumps from engineered equilibrium to survival bidding. That is how you get from $30 silver to $100 silver. Not in years, in a gap, in a week, in a panic, in delivery filia resolution, in industrial survival bidding. In truth, exposure. Now we close the loop with the strongest call to action possible. The question is not whether silver will hit $100. The question is, will you own it before the world realizes the rules were changed to keep you out, not to keep the market safe? Because when the trap fails, the price breaks. And when price breaks, the world wakes up. And when the world wakes up, silver is no longer affordable. The greatest transfer of wealth doesn't happen when prices are fair. It happens when prices were fake. And the fakest price in the world today is silver. Merry Christmas, and welcome to the trap they couldn't hide from you. If you want more scripts like this, subscribe, because the biggest market moves always happen when the world is distracted. But you're not distracted anymore.